In this session, we'll be talking about reforming LIBOR, why we should really reform, what were the problems, and other financial market benchmarks, whether it is Euribor or any other financial benchmarks, why do we really need to refine them? Right? So that's what is the article talking about. So I really need to make the benchmark rates very much less susceptible to manipulation. During the crisis, we all know that the benchmarks, especially the LIBOR, has been manipulated by the various banks and financial institutions. Now, why did they really do that? What was the motivation for the banks to manipulate the LIBOR, or for that matter any other benchmark? And what are the principles that I can really look at to make the benchmark rates less susceptible to manipulation? First of all, why do we need to use benchmarks? What are the advantages and disadvantages of it, and what are the implications of it? We are going to talk about that. Then we are also going to look at the different types of agglomeration effects. What are the real motives behind manipulating the various benchmarks? Different kinds of processes that the regulator or the central bank can really engage to reduce the manipulation practices. So going forward, what should be the way the dollar LIBOR needs to be used? What are the various costs that are associated with the LIBOR linked contracts? And what are the various methodologies that are proposed to reform the LIBOR? So these are the various points that we are going to deal up in this session. First of all, if you look at the way the LIBOR is calculated today, or even the Euribor or any other benchmark rate, they are submitted. The rates are actually submitted by market participants. Right? If you recollect the process of computing the LIBOR, every bank, it submits at a particular point in time at what rate it can lend for each of the time periods, for overnight, or probably for a week, for a day, for a month, 3 months, 6 months. So that is in different currencies. Basically, if you see, the process of computing the LIBOR is based on the data that is submitted by market participants. The various banks submit to the British Bankers Association. So based on this data that is submitted by them, the BBA typically computes the LIBOR. But what we are saying is, if I have to make it very much less susceptible to manipulation, the benchmark should be calculated based on the actual transactions being made, not by the judgment that are submitted by the participant. Actual lending and borrowing that is happening, it's not what they want to lend for. The actual lending and borrowing, the whatever is being done, based on that the LIBOR or any other benchmark needs to be computed. And the other important principle which can reduce the manipulation is fix the LIBOR calculation should not be just restricted to interbank transactions. Right? Probably it has to be expanded. A wider set of non-banking borrowings also should come in. Not just the interbank, any other bank borrowing, whether it is through the certificate of deposits or through the commercial papers issued by the bank. So all those things also should go as a part of the LIBOR computation. Today, the LIBOR is computed just based on the interbank market, which is not that broad. Whereas the proposal is, in case you make the calculation based on a wider set of unsecured bank borrowing transactions where you bring in the certificate of deposits and commercial paper as well, this can very much reduce the manipulation practices. And the process should be modified. And not just the LIBOR, probably even the alternate benchmark rates also should come into picture. So this will actually do a self-reinforcing choice by the market participants. But at the same time, there is a possibility to trade in more liquid, high volume markets. So some of these things, if they have been brought in, probably can make the benchmarks less susceptible to manipulation. So one aspect that can be looked at. Now, first of all, do we really need benchmarks? Are they essential? What is the kind of advantage they are bringing to the system? And what are their potential disadvantages? The first positive thing that I look at when we engage a benchmark is it reduces asymmetric information. Right? Probably one party knows more about a transaction, the other party doesn't. So that kind of information can be reduced by comparing it with a benchmark. I require at least this much of a return. So by comparing it to a benchmark, the traded financial instrument, whatever is the uncertainty that is lying, people can talk in common terms. And the search costs will typically come down, especially in the OTC markets, because now they can improve the matching efficiency. They have a benchmark, so the matching efficiency can be increased and even more participants can come into the market. Even the less informed agents also can start participating in the market, which means the volumes go up, liquidity goes up. So benchmark plays a very positive role there. And benchmark brings in even the transparency, because I can compare with a very clear-cut number. So even the investors, now they can delegate their trading activities to their agents. They can very well say that we have to meet this kind of a benchmark. Now, even if this becomes a kind of a onus on the agent that they have to make their best efforts to get the trade execution on behalf of their client, because even the client also knows what is the kind of a benchmark he or she is comparing with. So there are a lot of advantages that are going to crop up, and allows the banks to hedge at least the common component of their borrowing costs. Right? If there is a risk of change in the borrowing costs, at least they know that they can hedge the LIBOR part of it, or they may not be able to hedge the LIBOR part of it, because whatever is the kind of an instrument, the LIBOR related risk is inevitably present. So the benchmarks really help the banks and the financial institutions to start trading more in the markets. So they have a lot of positives compared to the negatives that they can bring in. Now, let's look at the different kinds of agglomeration effects that can crop up. Now, let's look at the market participants. If at all they are able to reap the information related benefits of a benchmark, it's an incentive for them. Right? So they have to understand the different information related benchmark benefits for a benchmark. So the search cost will be going down. How much return we need to generate, that cost is going down for them. because the benchmark is readily available. Today, this is the kind of a return. LIBOR rate is this much. So I need to get, let's say, 50 basis points above the LIBOR. So the search cost is going down drastically. People are clear, so the participation is much higher. Matching efficiency can be accomplished quite comfortably. I can match it comfortably. Risk versus return, risk adjusted return can be done quite easily. So the matching can happen quite comfortably. And even the moral hazard from the agents and all those can be reduced drastically. Especially when I am delegating my trading activity to my agent, that agent need not manipulate the stuff, and probably the moral hazard is reduced in that aspect. So there are lots of incentives if at all I start understanding the information related benefits of a bit. And the agents now will not start playing a blame game. They have to really work towards their best efforts. What kind of securities, what kind of portfolios really best suit for the purpose, right? So they have to really compare their trades with the benchmark trade, which can really keep them fit all the time, keep them put their best efforts to provide the returns to their clients, and the lower trading costs, especially those that are associated with liquidity, because more participation is going to come. The volumes of the trades are going to be higher. More volumes means bid-ask spread will typically go down. Execution time will be much faster. The delays in the execution will go down. Search costs will be reduced. And even if, because of high liquidity, even if a low price change, or probably even if a large volume of the trades are executed, the price does not change that drastically. So the costs that are associated with the illiquidity will automatically go down because of usage of a benchmark. And the attraction of a benchmark becomes more and more larger. So in case the positive feedback of transparency, liquidity start getting across the system, we see that the benchmark becomes even more widely used and the basin of attraction of the benchmark will increase quite drastically. And that is where probably we have to be very clear that the manipulation of this benchmark will have a kind of a significant influence on a very wider section of the society. Now, why do people really manipulate the benchmarks? It's a very interesting reason that we can see, because today the way the LIBOR is created is based on the information that is submitted by the banks to the BBA. Now, if they are giving a much higher rate, now that indicates that they might be less credit worthy compared to the others. They are willing to borrow at a slightly higher rate. If they are willing to borrow at a slightly higher rate, it's an indication that probably the outside world looks at them as less credit worthy compared to the others. So some banks really did not want themselves to be projected as less credit worthy, so they never submitted a higher rate. Because on one side that can create a kind of a concern regarding their cost of funding, and which can even result in a run on the bank. People might start withdrawing their funds and it can result in a very additional loss to the bank. So that's where they want to be play safe. So they never wanted to project themselves as less credit worthy. So they always submitted a much lesser rate itself. So that is what is the scenario. Especially we are getting only a kind of a submitted rate. So the true borrowing costs are not really coming into picture. They can very well give a much lesser rate. And on the other side, there is a second reason also for manipulating. So some of them want to profit on the positions, especially linked to a benchmark. So if at all there are big distortions in the LIBOR or something, so even if such kind of distortions are required, they are achieved through the collusion, and which is resulting in a misreporting among the different banks. So what is actually happening is much different from what is being reported. There is a kind of a colluded effect between the banks in terms of the reporting, whereas in the real terms the transactions are something quite drastically different. And that is where the overall benchmark, they wanted to get an advantage with respect to LIBOR related contracts. So that's where the reportings used to be always on the lower side, and any kind of internal deals are colluded between the banks to get an advantage. Now, how do I really alleviate? We have already discussed some of the measures, but obviously the most important one is the governance need to be very strong. The monitoring from the regulators of the entire fixing process need to be improved. The definition of the benchmark needs to be clearly defined. The methodology for computing should be very much in place. Rather than restricting only to the interbank transactions, the better way is have a large set of transactions, determine the benchmark. The more and more are the number of transactions that are there, manipulation becomes much difficult. Collusion becomes much difficult. So one single bank or a couple of banks colluding to put a high influence, that will be drastically reduced. So one alternative obviously is, while computing your benchmark, let there be more number of transactions with more number of parties rather than restricted to a few large banks. And even the time window needs to be widened over which the prices are averaged. So it's more like you are broadening the data, and the more and more heterogeneity coming up, that that heterogeneity, if at all it comes up, because I'm using different transactions of different entities with different credit ratings, probably we can bring in some kind of statistical methodologies which can normalize the stuff and still give a better benchmark compared to the others. So these are some of the ways where you can really manipulate, reduce the manipulations of the LIBOR and other benchmarks. Now, when we are using the LIBOR, so the usage wise today we see all the transactions related to the loans, bonds, securitization, derivatives, a lot of them use US dollar LIBOR, right? And which means across all these applications, majority of the contracts today, they are linked to 1 month LIBOR, 3 month LIBOR, some kind of a LIBOR rate. Today, that is the kind of a volume that LIBOR has traditionally created. So today, it's one of the dominant interest rate benchmarks, especially for trillions of dollars of conventional loans retained on the balance sheet of the banks and other intermediaries. So before bringing in some kind of a change, there has to be a very clearly thoughtful kind of a process. And at the same time, if that is manipulated, then the fortunes of many of the financial organizations is going to be very deeply affected. So a thorough study needs to be done before bringing in any kind of a manipulation in place. Now, if I am looking on trading of the LIBOR linked contracts, there are different kinds of costs that are associated. So interest rate linked products today, interest rate derivatives, interest rate, so within that again interest rate futures, bonds, swaps, lot of these instruments which are interest rate linked, they have grown exponentially over the last decade. Now, is LIBOR a real fit for those kind of interest rate based contracts? So what is being observed is, it's not an ideal fit, it's much less than an ideal fit for majority of the derivative transactions. So the liquidity related problems can create coordination failures, And even if now the market has to switch to a new benchmark, that's going to be much a difficult kind of an exercise, right? And now you could see this much of heavy derivatives are dependent on LIBOR, which means if I have to really manipulate the stuff, I can really get a big incentive, right? When the trading is such huge, large derivatives market is dependent on this LIBOR, there is a scope that I can manipulate, and if at all I am able to manipulate, probably there is a huge incentive for me, right? So compared to a market where the trading order is much smaller, if the trading is happening in a large number of derivatives, in case there is a possibility to manipulate the stuff, probably the incentive is going to be extremely higher. So the LIBOR fixing can be potentially be heavily profitable for a manipulator, which means there has to be a process in place which can make the LIBOR and other benchmark settings almost reduce the susceptibility of being manipulated. So there are a few methodologies that are being proposed. One of them, which is very heavily recommended, is the two-rate approach. So have two distinct type of interest rate benchmarks. The first one is a slightly improved version of LIBOR, especially for the bank's unsecured funding. So we are separating the unsecured funding from the derivatives transaction. So we are using the LIBOR, which is slightly improved with the current compared to the current version. So it is based on the bank's unsecured funding costs, which means it is based on the actual transactions, not on the rates that are submitted by the banks to the BBA. So wherever there is a credit risk component, this improved LIBOR can very well be used. Especially if my objective is reducing the revenues or hedging the revenues on the balance sheet, I can still use LIBOR as a benchmark. Whereas the second benchmark has no credit risk component, right, which is purely almost equivalent to a risk-free kind of a component, especially for the derivatives market. So this should fit the risk transfer needs of the traders. It should not include the credit risk component. That will make the derivatives trading component completely separated from the funding costs of the bank. Two different benchmarks being used for two different purposes, so the scope of manipulation is much lesser. Now, whenever we are designing this kind of an approach, a few things. So, how can I really design this improved version of LIBOR? So, the major focus is it should not be based on the transactions on the rates that are submitted by the bank, but it should be based on the actual transactions. So the discretionary reports of their funding costs of the bank should not influence the setting of the LIBOR. So what is the way that process can be designed? Similarly, almost the riskless or risk-free kind of rate should be used for trading application as a benchmark. So what rate should I use? So should it be some rate that is administered by the central bank, like your the Fed funds rate, or should we go with a repo or a reverse repo rate kind of a rate? Should we go with the treasury bill rate, collateral based, general collateral based repo rates, or overnight index swap rates? Which of them should be used as a proxy for almost risk-free kind of an interest rate? What are the merits and disadvantages associated by using each of these rates as a benchmark? Because none of these alternatives is perfect for all applications. But again, I need to really look at the context. Right? So whatever, right now they are all substitutes for LIBOR. Right? So they are feasible, they are effective. So only thing we need to see is for what kind of context, what kind of benchmark is much more suitable. And today, probably the existing LIBOR, it is based on trillions of dollars of contracts. Now, how can the policymakers help to break this, and where they can really promote this two-way regime in the process? So all these become challenges, and those are the various areas that really need to be looked at before implementing these kind of approaches, which can make the LIBOR and other benchmarks less manipulated. The incentives for manipulation will go down quite drastically provided such a kind of mechanism comes into picture. So that is what I wanted to offer as a part of this video. So we have looked at all these aspects. A summary of all those aspects that we have initially listed in the agenda is provided here. If you have any further queries, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@facegurus.com. Thanks a lot for listening to this session. Thank you very much.